Okay, everybody. Let's see. I read a lot of books, usually between 3 and 5 a month, and so I've started telling people the book of the month. Book of the month last month, because I forgot to tell, was Dollars and Cents by Dan Hartley. And he talks about psychology of selling. And the book's not on how to sell, it's just more on psychology. But if you listen to the book, you can think of ways to use what he's talking about in selling your home or keeping people from using it against you. And the book for this one is called Grit. And it's by Angela Duckworth. And it's about how people stick to stuff and how they just don't give up. I consider myself average intelligent, maybe. I'm definitely not one of those genius guys. But I know my number one trait that is really good for me is that I don't quit. If I decide I want to do something, that's it. And I won't quit until it's done or until I see that it's not a good thing to do. I had a dealership for a while until my sister was talking to me about real estate. And if you sell a car, you make $1,000, sell a house, you make several $1,000s. So I gave up my dealership license and turned it in and went into real estate because I'd already done rentals for years. But actually buying and selling a house, I never really thought about that. And so when she got with me and stuff, it made lots more sense to sell houses instead of cars. So, if y'all know anybody that has any kind of subject that would be interesting for the group to listen to, talk to them. Let's get them on here. Mike's got one person that we're going to hear in a few months on IRA. They're IRA cookbook. And so last month's speaker was from a lady that we were sitting right over here, and she said, how come y'all don't have any CPAs or lawyers or anything? And so I started looking for that. The note person, it also came from a conversation. My note person that I had set up fell through, and Mike had another note person. So if you know of anybody in the subject would be good for us to learn, let's get them up and let's get them here. What we do tonight is not legal, accounting advice, or any professional advice. It's just for your enjoyment. Come up with an idea, take it to your account or your professional and check it out. Because we're not giving any kind of professional advice. This is Casey Gregersen. Say it again. Gregersen. I have it in my phone and I know how to spell it. Casey and I met, I don't know, probably about 6 months ago. Yeah. And he's a really neat guy. Maybe at the end of this he'll tell us about his wife and him have a franchise. And maybe
I got it incorporated in there. Just for you, Lee.
Oh, you got it? Okay,
yeah.
All right. So he lives in Midland and he's going to tell us about one of the properties he's bought.
You bet. So thanks for the introduction, Lee. As he mentioned, I'm going to talk about the Brrr Strategy. So a lot of you guys probably don't know what that means, or maybe you do know what it means. That's not what you call it. Talk about using hard money. So I think it'll be good for, I know like Rachel, a couple like new people, or maybe, I have no idea your experience level, but what deals you've done. But new people, I think it'll be a lot of good examples of deals we've done, how we put them together, and also the experienced guys in here. You can hope some of our hard money stuff I share. I've used a lot of different hard money lenders just in the last couple months and learned a lot from that. So hoping you guys can draw off something from this. So as Lee mentioned, my name's Casey. I got my start in real estate actually in college. So I was getting my master's in Petroleum Engineering, and actually my dad helped me come up with my down payment to buy the house. It was actually my roommate's house at the time. So he helped me get the down payment, bought the house, and my renters paid my mortgage throughout college, which I thought was pretty cool. But then it got even better when I graduated, so I filled my room, and then it started actually cash flow. So I started to all of a sudden see the whole benefit of real estate right there. And led us to this property. This was the first house that me and my wife bought up in Billings, Montana. So it was built in 1914. An old craftsman house, really cool, near downtown, but definitely needs some remodeling. And my wife wasn't. Welcome, guys. How you doing? Good to see you. Thanks for coming. So we got into this house. My wife's initial plan was just to pull up the carpet and redo the kitchen. Got the kitchen, and that was kind of the plan. And lo and behold, it turned into a huge all-in remodel. We'll go through some of the pictures, but redid the kitchen, the living room, all the floors, the entire main level. Ended up gutting a bathroom upstairs, which was, I think I got one here. Here's some more of the dining area. Gutted that bathroom. Did the one in the basement. We ended up totally refinishing the basement, which was nothing but storage. So refinished the basement, added a lot of good square footage, which not a Texas thing, I know, but up north you can get basements and add square footage, which really helps a lot. So redid a basement. By the time it was all said and done, we actually built a 2-car garage as well. So I was lucky. I had a father-in-law who was super handy. He taught me everything. I didn't know really any of it, but we did it all by hand. And if he didn't know how to do it, he had a buddy in town that was a plumber or somebody else, and it was just turned out to be a great deal. Learned a lot of hands-on stuff, but probably the most important lesson I learned is I don't want to do that all on my own again. I want to hire a general contractor. So learned a lot from it, but the other kind of cool part about it was it helped us when we went to sell it. So kind of my background, I've been flying in and out of Midland for like 3 years. I'm a company man for Shell. That's my full-time job. So I fly in and out 2 weeks on, 2 weeks off, and decided, me and my wife, we want to see the family every night. So we moved down here, made the plunge, moved to Midland, and sold this house. And so it wasn't a planned flip, but kind of turned into a little bit of a flip. And we did make a little bit on it, enough to buy our house or put a down payment down here in Midland. And then the other cool thing was we had enough to buy a franchise. So that's where I'm going to talk a little bit about Pure Barre just briefly. So anybody heard of Pure Barre other than Rachel? It's okay, good. So it's a women's fitness studio in Midland. So kind of how we ended up finding this was my wife was a member in Montana, in Billings, Montana, and she didn't really have, so I was gone every 2 weeks, right? Not really around. She's a stay-at-home mom with 2 kids, and that's all she was doing. And so this was like her release every day. Get away for an hour, go work out, just focus on have some mom time, get in there. So she loved it, and it was a sense of community and just a really cool thing. And that's why we decided to bring it to Midland. Actually, we checked into Midland, didn't have one for some crazy reason. We got lucky because it was a market that needed one. And so we looked into it. I'm a math guy, so I put together a business plan. I enjoyed that, did all the numbers on it. Made sense, and a little bit more kind of about it to show you what we do. So it's actually, we do sell women's retail. We sell clothing, activewear, so that's part of the business. The main part is obviously the studio part, so it's kind of cool. It's a cool niche in Midland because there's not a whole lot of women-specific workouts, and it's not designed for them, and it's a perfect thing for a women's body. I won't give you the full spiel, but really cool workout, and not a whole lot of them in Midland. So let's just see some pictures of what we sell, and that's actually the studio there. But back to the numbers. Put together a business plan.
Tell them where it is.
It's right there. You guys want to know where Double Dave's is, or Cole's in Midland, right off the loop. So we're right next to Double Dave's and Sport Clips, right between them. So trying to figure out how to put it together. We made some money on the flip, but not enough money to pay for a franchise cash. So went the SBA loan route. So anybody ever done an SBA loan in here? Yeah. She said long route, so that's absolutely right. I like to say it was a full-time job in itself, just managing the SBA loan. You think doing a mortgage on your house is a lot of paperwork and stuff. It's way more than double. It's a lot of work. But at the end of the day, we didn't have an option. And the cool thing is, so it's an unsecured loan, right? We have some equipment, but we don't have a property to back it. So that's why there's a lot to it. But we were able to get pretty good terms, I thought. So we got a 10-year loan on it. The interest rate was around 6%. And we put 25% down. So I shopped around like just the Midland, Odessa area trying to find somebody that would do the loan, and everybody was 30 to almost 40% down, which was at the time pretty substantial. So we actually called around, found up in Minnesota, in Minneapolis, found a little small bank that would do 25% down. So that's what we went with, and As you can see, kind of what we paid for was our build out, our franchise fee, all our equipment, fixtures, furniture, and training all our employees, and basically everything to get our doors open, and then have a little bit extra working capital. Go ahead, Lee.
Is the loan fully amortized after 10 years?
Yeah, it's a full, so it was like 6 months interest only, and then, yeah, amortized over 10 years. You got it. So we, did the SBA loan. Turned out to be good. We'll be open in May. It'll be our first year, so it's been kind of a cool deal. Any other questions on Pure Barre? Or I can yeah, it's been profit. That was going to kind of lead to next, kind of led into the next business, but basically, so I used all my cash to do that, all the extra cash or savings I had to do this, and everything we've made since, we've reinvested to try to grow it, but I haven't ever really had any cash, so it has been successful, but haven't got to really pull anything out yet, and so I kind of left a gap inside me. I've been missing the real estate thing, so wanted to somehow get involved, but really didn't have the cash to do it. So led me into Inline Investments. That's how I created this company with, so I had a buddy in Dallas-Fort Worth who'd been wanting to do real estate. He'd been talking about it, and he'd been asking about what I've been doing for real estate, and always asking questions, and always telling me about DFW. So I don't know how much you guys have looked over there, and it's pretty, he kept telling me about the deals, and literally, how many of you guys heard of the 2% rule? Read about that? Mike? Yeah, Rachel? Okay, so 2% rule, easy numbers, and literally you could probably hop on Zillow and see this on the MLS in Fort Worth, but there'll be properties you could buy for $50,000 that rent for $1,000 a month. So divide 1,000 divided by 50,000, that's 2%. So 2% rule is like awesome. I mean, to me, I don't know what Mike thinks. Sometimes I think 1% is about break even. You're not going to make a whole lot of cash.
1.5.
1.5.
If I can get 2, I mean that's just almost guaranteed to the cash flow.
Yeah.
So, yeah.
Absolutely. So
deals are really what you want to be shooting for.
Yeah. Yeah, so 2% deal, a lot of deals in Fort Worth. So finally, he's like, why don't you just do one with me? I'm not comfortable to pull the trigger. Let's do one together. And I was like, yeah, let's do it. So we used a home equity line of credit for $72,000, and used another. Found a private guy who did $60,000. So all in, $132,000. So what can you do with that? Probably get one property, right? You could go, and we wanted to pay cash. We wanted to get that discount on a cash deal, right? So $130,000, we could have bought something for $100,000, put 30 into it, try to refinance it, do that whole thing, or maybe really stretch it by 130, try to like use Home Depot credit cards and stuff, just float it maybe, but really couldn't do a whole lot other than maybe just one property. So that's when the hard money guys started to come into the picture, and we realized what we could actually do. So, and we started researching, looking around Dallas-Fort Worth, and Dallas-Fort Worth is, compared to Midland, I was looking at Midland for hard money lenders, not much luck. In Dallas-Fort Worth, there's a lot of them, and they're competitive. It's good rates, and they basically allowed us to go out and get, instead of one property, we got 6 properties. So this is kind of the breakdown. We were able to get, with that $130,000, we bought 6 properties, a total of 10 doors. Now we got all the properties appraised recently, so appraised for $1.15 million, and the cash flow is $2,000 a month. So $2,000 over $1 million probably doesn't look great as far as cash on cash, but all these are 15-year loans, so they're 15-year AMs, so you're paying out a little quicker. But at the end of the thing, you guys, so I know Mike probably knows, you guys, anybody use cash on cash to look at your investment? You're basically dividing what you're making each year by how much you put in. Well, in these investments, we did these 6 properties, we refinanced them all, and we got that $130,000 back. So now our cash on cash is infinite, right? We got all the money back. So to me, and $2,000 a month is still great cash flow, but either way, we weren't as concerned about a low number there, but we got all our money back, and so we can go repeat it. So I'm going to kind of go through that whole process here in this presentation, show how we did that. So here's the table, and that's the one I handed out. That's the first page. I'm going to go property by property to not do all of them, but I'm going to use some to illustrate what I'm talking about. Just wanted to look at the full, so the down payments, that's the first column. So to get all those, it took $82,000 of our 132. So, and then all of them financed was $634. And as you can see, add up all the ARVs was about $1.15 million. So, and the total rents, $11,600. That's where I got my cash flow. I subtracted out all our expenses from that. But anyway, we can dive into that later if you guys want, but you'll kind of get some better illustrations as we go. And the pictures are all behind it from each property, but let's do this first one. This property is actually not in the packet. This was our Fletcher property because it's actually just finishing up here in the next week, but we've already got the appraisal back and everything, so we know the numbers. Anyway, the Brrr Strategy. So who has read about that on Bigger Pockets? So for you guys? Okay. So I want to kind of use a specific example to explain how we used it and the power of it. I mean, to me, if you're just getting started, this is the most powerful way to grow and really do a lot fast. So the first one, buy. So we bought this property for $80,000. I mean, you can see by the pictures, this property was in rough shape. It was actually on the MLS. It was listed around, I think, $95,000, but I don't think anybody touched it because it wasn't going to fall over, but about all you could keep was the studs, and it looked terrible. So I think a lot of people were scared on it, and then a lot of people were just scared, I think, to make a lowball offer. So we offered 80. We got it. We sent our contractor out there. The next R, we go in and rehab. So sent out our contractor. He came back, said it was an $80,000 rehab. So big project, but the cool thing is he's turnkey. Like, we give him, he does the permits. He does everything from start to finish. So the nice thing is we close the loan, let him take over, and then when he's done, we come back. So $80,000 turnkey. All our holding costs on this were $16,000. So it might seem a little bit high. A lot of that is the front end. So on the front end, you got to pay to go to closing, right? So we got to close it on the front end. You got all your holding costs. So if you're paying interest on a loan, taxes, insurance, all that different stuff, and then you got to refinance on the back end. So that's all in that $16,000. Kind of high. I mentioned too our down payment, $20,000. That's a little more than we like to put in to start out, and I'll explain that a little more. But so we've used a total of 4 hard money lenders, and I'm going to kind of throughout this presentation talk about the pros and cons of each one we use. I'll tell you this one was by far the worst hard money guy. I would not recommend him, but I'll tell you why and different stuff. But $20,000 wasn't what we were looking to pay. The deal was it was way undervalued. But he made us put a full year's worth of taxes up front in escrow. He made us put a full year's worth of insurance in escrow. He made us pay like this home warranty, and but a full year. But I mean, it's a 3-month flip. Like, why do I need to put a year's worth of escrow in there? And you're going to get that money back, but at the same time, I don't want to. It's just sitting in there. I want to use that money. So that was one downside to it. Some of their holding costs were higher, and their points. But I'll get into that. So next step. We're done with the rehab. Now we got to go refinance it. That's the third R here. We took it to the bank, got an appraisal for $230,000. But I want to ask you guys, so who's done a purchase other than probably Mike, done a rehab or a refinance on a rehab refinance? What did your lender give you? Did they, as far as ARV, did they do you remember 70, 80? 75, okay.
I got 80.
80?
Yeah.
Yep. So we were promised 80% ARV, and again, some of the new people, I'll explain all that here in a sec. But we were promised 80% by this bank. We got all done with the properties, sent it to them. We actually created our business checking account with this bank, small bank. Thought it was going to be great. We go refinance. He goes, yeah, they're not going to approve it. You need to do 20% of your cost. And I was like, that's not what we talked about. We talked about ARV. That's a huge difference. So anyway, we started talking around. Lo and behold, found a guy here in Midland. You guys, anybody familiar with Lone Star Bank in West Texas? It's down on Big Spring, real big building. Worked with Jacob Burris, actually. I don't know how many of you guys know him. I just talked to him today, actually. We just closed on a flip today with them. And anyway, he's like, tell everybody, give him my contact information. So I will when you guys are done. He was able to get us at 80% of the ARV. So looking at the numbers here, up here, commercial loans. So 80% of the ARV of 230 is 184,000. And I told you up here, our all-in cost was 176. So we actually made an extra 8,000. So that 8,000 is in addition to our 20,000 down payment. So at the end, the last step is what? Repeat. So we were able to take 28,000 to the next deal. So we got all our money out. That one's all done. I like to sometimes add a fifth one in here. You can't quite see it, I don't think. Yeah, rent. I like a fifth R. So, I mean, you're renting it, right? We're renting it. Our rent's around $1,975, pays the mortgage. We're going to continue to keep this property. But again, we got all our money out. So to me, your cash on cash return is infinite, right? So that's a good illustration of the Brrr method.
So instead of selling these, you're gonna refinance?
Exactly.
Your initial money out, and then just rent it?
Rent it, exactly.
Okay.
Yeah, so we got our initial 20,000 that we had to put down, got it back out. This one was great because we made an extra 8,000 in addition to basically that 20%. And yeah, keep going, questions as you guys go. And I'll give you time at the end, but it's better if you ask them during it. It's more relevant. Next thing, hard money lenders. So how many of you guys have used hard money lenders? You guys have? Lee? A lot of people use them, okay. And what do you guys, does anybody have any idea what hard money lender means? So basically, what does it usually mean? I'll put you on the spot, I haven't met you yet. Or what's the pro and con of a hard money guy? What's the, I guess the con? The downside of hard money? Yeah, either of you guys. Yeah, lots of points, lots of fees, right? But the good side is they're fast, right? They can close, maybe you don't have great credit, and they can close quick. So I'm going to kind of go over all the pros and cons of it, and mostly the cons, why they've worked so good for us. So first thing is points. So put Mike on the spot here. What's a point? Just so the guys that don't know on a loan.
So your points are, and you may be able to explain it better because I've never used hard money.
Hard money, okay.
Yeah, so
I'll do it.
I'll let you,
Okay.
I'll let you explain it.
Yeah, so hard money, so it's real simple. I did easy numbers,
Percentage for every-
3 points, yeah.
Yeah.
It's just a loan origination fee. You do it on every loan, even if you're going to get your mortgage on your house. Every lender's going to have a little, right? It might even be a point or half a point. These guys are higher, so say they're 3 points.
That's
Yeah.
how they make their money.
Exactly, that they make their money on the front end for sure. That way, if you, yeah, I was told that once too. In case you go and refinance it.
Yeah, you let me refinance it in 6 months.
Yeah.
They're that points is how they make their money.
Yep, they get their money right away. So easy calculation, 3 points, 3% of the loan. So if your loan is $100,000, you're paying $3,000 up front. So that's a big downside, right? You got to pay that money up front. The next one is the interest, like you guys started to say, high interest. I heard that one.
It's deducted from the loan.
Yeah, exactly. So 10.5 to 13% is what I've seen annually, but it's annually. So I try to remember, like, that's a sticker shock, right? Like on your guys' house, or you guys are probably trying to get in a loan at 4 to 5%, right? Maybe 6. So that's 12, 13%. But the way I look at it is 12% annually. So let's look at that, round numbers. Say this only taking you 3 months, you're only going to pay 3% effectively, right? Say it's 4 months, 4%. So it's annualized. It's not like you got to pay that full of your full loan, you know. And the other part is it's just part of your numbers. It's part of your, when you look at your rehab, you add in your purchase, your rehab, and then you add in what are your fees going to be. So if it's a deal, it's a deal. If not, I mean, you could just not buy the property because you don't have the cash, or you could maybe use the lender and actually make it work. So that's kind of how that interest works and how we look at it. Probably the big game changer with these guys is how nimble and quick they are, especially the ones we found. And I didn't find these till I went to Dallas and found these lenders out here. So these guys can close in like 48 hours. They're awesome. They look at the deal. So a lot of these, the good ones are actually former flippers, and I didn't realize this till I got into it. The good ones, yeah, they've been flipping forever. Now they got all this extra cash. They're trying to flip it. They're like, I'm going to lend my money out at 13%.
They'll let them underwrite it, and they'll tell you whether it's a good deal or not.
Exactly.
There you go.
My kid, perfect. So literally, the process is we got a good one. I get a deal from a wholesaler in the morning, which we do a lot of our deals through wholesale. I look at it, we like the deal. Okay, I just plan to go look at it. In the meantime, I send out that deal to our hard money guy. He looks at it, and he gives me an answer the same day. He basically underwrites it then. Okay, yeah, it's a deal. I've done this for 30 years. I know it's a deal or not. So he'll give us an answer by the afternoon. It's a go or it's a not. No, don't do it. It's too risky. And if all else, he's a good check and balance for us, which we like. So he checks it out. He tells us what he'll lend on it. And then we go to the property. Look at the property. We like it. All right, we offer cash to say, hey, we'll close 48 hours if you need. Well, usually the conversation is we'll close as soon as title's ready or as soon as your seller's ready. But effectively now we're cash buyers, and it makes a huge difference, right? If you're a cash buyer, you got all the leverage. But are we a cash buyer? Not really, but they don't know that. And these guys are trustworthy. Never had a guy not show up to close, so they got plenty of funds and they want to do deals. So effectively, you say you're cash, you can compete with cash guys, and they're nimble. So that's the biggest thing. And you got to ask, when you are asking your hard money guy, how quick can they close? Are they going to pull? I've talked to some they claim they're hard money guys, but they still pull a full appraisal. To me, that's not really hard money. That's a conventional loan. But like that first deal I was telling you, they made us do a full appraisal before we even bought it, which you could do if you find the right deal, but you're not going to pay cash for that, right? So last thing is the down payment. So I'm going to give you two different examples of one where it's 10%, another one where it's 70% ARV. And it'll make more sense in these two deals. So here's a deal we did it, it's actually really close to TCU, real close to campus. We bought it for, the sale price was $126,000. So this particular hard money lender will lend you 10%, they make you put 10% down of $126,000. So we had to come up, as you can see the first column, $12,600. The cool thing is they'll 100% finance the rehab. So literally to buy this house, we needed $12,600 plus closing costs. We did, you can kind of work through the deal, and you guys got it in your packet as well. Everything all in, you looked at our holding costs, the ARV, which we just got back from the bank on the refinance. It ended up, the total equity, I call it total equity added, was $30,000. So if you were doing a flip, that'd be what you keep. With us, that's what we're using as our basically down payment on the refinance, if that makes any sense. Because again, we got to be at 80%. Ideally, we try to be at 80% when we're all done, so we don't have to bring any more money, if that makes sense. And I can explain that a little more. I'll show you the other scenario. It's 70% of ARV. So the majority of guys will give you 70% of ARV. And if you're at 70%, you don't have to bring any money. So this is an example of a deal that we actually didn't have to do any money down. And I did a little screenshot of our YouTube channel. So if you guys, later on tonight, go check this out. It's a more detailed version of what I'm going to go over now. But it's a quick summary of this deal. So look up at the top. Sale price $114,000. We were going to put $30,000 into it. So all in $144,000. So call up the hard money lender. What's your ARV? Okay, he says his ARV on this property was actually $215,000. So multiply 215 times 70%, 215,000. Am I losing people? I'm going fast. I like math. But anyway,
What is the ARV for?
after repair value. That's a great question. So, and it's an important thing to look at. Somehow you got to quantify what's the property going to be worth when you're all said and done. And the bank, the hard money lender, he looks at that number. He knows, and he looks at comps around the neighborhood, right? So he looks at what's this house sell for, all fixed up. And he bases that off your rehab too. You tell him what you're going to fix up, everything you're going to do. So this 150 number is actually greater than our all-in budget of 144, right? So that means no money down. If it was less, we'd have to come up with a difference to close on it. But a really cool deal to where literally when I went to closing, we brought $5,800. That was for title, the points, and that's all it took to buy this house was $5,800. So really cool deal, and I think this one's not quite done, but again, we've already got the appraisal on the refinance, so it looks like we're going to add around $33,000 of equity to our portfolio. Have it rented out, and again, all for $5,800 down. Important part I wanted to talk about here, and we literally just learned this in the last month, is in talking about different hard money lenders, something to ask about is how they do their draws, the construction draws. So it can be really easy and it can be really hard. So going on this property, $30,000 was my rehab, right? But to get that $30,000, I have to submit all my invoices. I have to get all the lien waivers, a lot of paperwork, and then I got to order an inspector to come out and pay $200 to come inspect it, and then I got to wait maybe another week for them to get the inspection stuff back, get everything in there before I actually get paid back on my stuff, get paid back on my rehab. Problem is, the other kicker is they won't pay until it's complete. So it's based on your work scope. You give them a work scope, this is what I'm going to do, and they pay based off that. So say you're trying to collect money for all your tile, but you've tiled everything in the house, the kitchen, the bathroom, everything, but maybe just a little part of the kitchen you're waiting because your cabinets haven't gone in, so you're just waiting on that. Well, he won't pay you for tile until that's all done. So it becomes kind of a headache to where, honestly, on this deal, we just made the decision this week, you know what, we're not even going to apply for a draw, we're just going to try to front that $30,000. We'll get it all once it's done in a week, and then we'll apply to get it all back. So it puts you at a disadvantage because you're having to come out of pocket for that $30,000, which is a good question to ask. Which on the other alternative, the guys that did this property, they're the best hard money lender I've ever seen, and it's more relationship based, and they call it more private money lending. They call themselves a private money lender. So they actually give us 3 draws. They give us a third up front. So they'll, using round numbers, $60,000. They'll give us $20,000 as soon as we start. So now I can use that to get started, buy our stuff, pay my GC. He can start to pay his subs, and then I get half of it in the middle, and I get the last third at the end. It's a really cool deal, but that's not it. These guys don't make us do an inspector. We just take pictures, and we upload them in a Dropbox. So we just go take pictures. They get it. They look at Dropbox. Okay, yeah, he's done. The kitchen's done. Bathroom's done. All the tile, I can see it. Okay, and they wire the money the same day. So it's super easy. We don't have to come out of pocket $30,000 to front. So if you could find a lender that will do that, go with them. But at least that's a question to ask: is how does your draw process work? How long does it take to get paid? How much does the inspector cost? How long is it going to take for him to come out and inspect it? So definitely a lot of things to look.
This would be in the best. What were the points that you pay on the front end?
2 points. Yeah, 2 points.
So isn't the reason you're using hard money, you're paying those points up front so that you can actually get the money to finish your tile work, right? So, I mean, isn't that kind of...
I'm with you. I asked myself the same questions, like, why? Yeah, back to this property. I'm just waiting until $30,000 to do it at the end. Why did I even take out a loan on it? And I asked the lender that. I was like, so why do people even take that out? And he goes, well, they just want to get their cash faster. So if not, odds are I'm going to wait a couple more weeks to get it refinanced and still be a little bit longer to get my money back. But honestly, you can almost time out your refinance. So we ordered the refinance on this already to where it should hit right when it's done.
Right.
And not have much time. So
and not pay any points up front.
Yeah, you would still pay points on the purchase price. But are you saying using the conventional guy or a commercial loan from the
So
start?
I guess I'm confused on so you're using hard money to purchase the property and then rehab it, correct?
Yeah.
Okay, so you're using hard money to get into the property, and then if, let's say, a section of tile or sheetrock or whatever it is that you're waiting on isn't finished, but he won't give you any more money. I mean, isn't that the point of borrowing the hard money and then paying the points up front? So you have everything you need all in one go round.
Yeah.
So there's not this back and forth like, okay, now I'm at a standstill. I can't finish my rehab because I don't have any more money.
Yeah. I agree 100%. It's still people.
I'm just a little confused
So,
on that section.
yeah, and again,
I guess they don't want you to go to the strip club to start spending money.
Well, that's not fair. He gave it to me.
yeah, you paid points. The thing is, I paid. So it's frustrating too because you paid points on that entire loan, right? So give me the money that I'm paying points on. So, but unfortunately, they're almost all like that, and that's a good question to be like. But they're covering their ass. Yeah, covering their ass. In case you don't.
I didn't mean to put you on the spot.
No.
I was kind of curious. Like I never borrowed hard money, so I wasn't really sure. I didn't know you had this back and forth, like turning receipts and proof that you did the work, which I understand that makes sense.
Yeah, they want to. Yeah, because they've had too many people run out on them.
Full-time job.
Exactly.
Some people
And
actually
that's
get
why.
carried away, when they have a lot of cash with them, they kind of misuse them. So sometimes they act money lender, sometimes they put you in check.
Oh, yeah,
To be
that
honest,
makes
they put you in
sense.
check.
Okay.
But-
Because if
So you
they
don't
do it,
overspend, maybe?
pretty much.
Gotcha.
Yeah, because a lot of times people just
Okay.
they get their 60 grand up front and see you later.
Gotcha.
And those guys lose their money.
That's the difference between hard money and private money too, so.
Great point.
And the guy, that they're calling themselves private money, they're still not fully private money.
Yeah.
But that's part of the difference too. That's why people like to use private money, not hard money.
Right. Okay.
Yeah, that's what's cool about. Oh yeah, a couple things. So, but they do still work good on like this property where that budget was 80 grand. I've actually done the draws because this is like a 3-month rehab. So each month I've gotten some back. So I've recouped some back. I haven't got it all, but I submit an invoice for $24,000. He gives me 17. I submitted another one for 29. He gave me 20. So each time I'm having to put a little more, but at least I'm not having to put 80. So in this scenario, absolutely do it.
Okay.
But in the scenario where this one I just talked about, where it's 30,000, honestly, we didn't. I should have just took out a loan to get the property under. I should have just took out a loan out on 114
Okay.
on the purchase price because I didn't. It was no money down, so I could have went to a bank, said, I'll give you 25% of the purchase price or 20% and done the purchase price. But again, these guys are way less down.
Right.
But honestly, if I do it again on this one, I would just say, give me enough money to buy it. That's all I want. I'm gonna pay for the rehab anyway out of pocket, so why am I gonna pay you an extra? So the loan would be smaller. The loan would just be the actual. But that's a really good question. And then again, he made a really good point. This property where they give us the money, part of the money up front, they call themselves private guys. They're not a true private guy. So the disadvantage of private guys, as I've heard, is if it's just somebody you know or whoever it is, like, who knows if they're going to show up to closing, you know? Like these hard money guys, at least they're reliable. You know they're going to close. Versus your private guy being, who knows what happens? He might not show up to closing, and then you don't have that cash, right? But these guys are kind of a hybrid. They're more private. So this is what I was going to say. What our plan with some of these guys that are more stricter is once you get a relationship, it turns from hard money into private. They start to trust you. He knows you're not going to run off with this money. Okay, I'm going to give you 50% up front or 33%. That's what we're trying to work to with these other guys. But the only problem with the private money guys, they're a little bit limited too. Like we've had some deals where they're like, I'm sorry, we actually have all our money allocated. We don't have any cash to do this deal, so go talk to the next person. And again, probably because they're so competitive and so good. So you got to move to the next guy. But yeah, that was about it. I was going to open it up to questions. But first off, offer, you guys got any question? Everybody's got my card, and my information's on the bottom of that little handout. Call me, email me if you got any questions from today if I don't answer it afterward. The other thing I wanted to offer is anybody interested in partnering on a deal. So all these deals are out in Dallas-Fort Worth. So I know in Midland it's really competitive. So I've been looking in Midland. It's hard to find anything, right? I went and looked at, did anybody look at that one that was on the MLS a couple weeks ago over by like HEB off of Midkiff in Midland? I keep forgetting the name of that street. Dengar, yeah, Dengar.
Yeah,
Anybody look at that one?
Yeah, for 200.
Yeah. What did it sell for?
Was it a duplex?
No, they were asking 130. It sold for 165.
165, yep. It was listed at 130.
They were asking 130.
And you sold for 160.
Did you offer on it?
Listed for 130.
Did you put in an offer?
We actually got a call from it while it was off market, and we went and looked at it and inspected it and everything. And we were gonna make an offer, and we tried to get a hold of her, and we couldn't get a hold of her. And then she called us the next week and said, "Hey, we put it on the market." We were like, "Ah."
Wow. Well, you guys are good wholesalers then, so I was talking to you earlier, so get that stuff. That's what we're looking for. So that's awesome. So anyway, it went for 165. I offered actually 141 on it, and I thought I was stretching it. But it needed like over 100 grand. So you guys know it needed a ton of work.
We put it at 105.
105 rehab, so
What's the ARV on it?
over 300.
Oh, is it? On Denver, 100 bucks?
It's like 3 blocks
From like
east
Midkiff?
of Midkiff.
Oh, okay.
3 blocks east, 3 or 4. But yeah, it was a good layout. But anyway, it's really hard to find deals in Midland. So if all else you guys can't find a deal, so one of the guys, he was going to come tonight, didn't make it. They're Carpet One. They do flooring in Midland. Anyway, I started telling him what we're doing. He's like, man, I want to get on that. I want to partner in that. So he's going to partner in on a couple of flips with us and put up some money and share the profit. So I'm open to any of that. If you guys are interested in getting in Dallas-Fort Worth, there's plenty of deals. It's just, with us, we're kind of a startup. We're still cash poor at this point. We had 130,000. We've got
I was
most
just going to
back.
ask you if you were going to start raising money for other projects.
Yeah.
So is that something you guys are starting to work on now?
Yeah. So
You're going to mix your hard money with, I'm sorry, go ahead.
No, you're great question. So today that was the one I closed on today. We actually had a investor. She brought in, I'll just tell you the number. She brought 25,000. She's going to share 10% of the profit on the flip. So we're actually combining hard money and private money to make it truly no money down, which allows us to grow. So, but yeah, so looking on that. And then the other thing is some of the new guys in here, I recommend just doing that same scenario, partner on us. You'll get part of the profit, but we'll just include you the whole step, every step from finding it to setting up the financing to doing the rehab. We'll include you the whole way and do a couple deals with us. And then hopefully you'll go try one on your own. But for me, it's a win-win. We need capital, but we got the experience, we got the deals to do it. You get some experience. Kind of like my business partner that we created this company with. So definitely reach out to me after that, and yeah, I'll open up questions.
Are you holding any cash reserves back per property or as a unit? So that you could work this out or something?
Definitely not enough, and that's what we found this last week with that 30,000. We had to inject a little bit money in to front that.
Well, I mean on the rentals.
On the rentals. Oh, okay. Keeping money back. So we're making a little bit more on our rent to where we're not going to touch those accounts. So like some of these that are cash flowing $200 or $300 a month, we're going to let that sit in that account. So that's a really good point, and I wanted to bring that up tonight. So we keep all these as rentals, right? We're refinancing them. We are doing some flips, but this stuff here are all buy and hold, refinance, hold as rentals. The cool thing about these big jobs, like this house, back to here, I mean, this is like a new house almost now. We gutted everything to where I'm sure Lee's getting into like, okay, what if stuff breaks? You need to be ready for different stuff or you have a vacancy. So the cool thing about going in and fixing everything is now these first couple of years, your capital expenditures, your repairs should be pretty minimal, hopefully. And screening tenants, as Lee would say. So that's an upside, but yeah, we're planning to grow the little excess cash each month, let that sit for something that does happen. And having multiple ones, just the diversity. So we got 6 now, we want to get 6 more. And then, so vacancy doesn't kill you. So it gets into like multifamily. You can, if you have a vacancy, if you got 10 units and you got a vacancy, you're okay. But if you got 1 or 2 units and you got a vacancy, that's half your cash flow. It hurts. So,
Or all of it.
yeah, or all of it. So we're trying to scale up, get multiple. So we got 6 now. If we can have maybe 25 by the end of the year, then I can have a couple vacancies and I can keep all that extra cash flow from the ones that are doing well to have a little bit of cushion.
Are you self-managing or management company?
Yes. Yeah, good question. So self-managing at the point, and I'd like to, so I've gone back and forth. We had planned to hire one, but I mean, yeah, I'm sure everybody's got an opinion on property management.
Yes,
They don't do a big.
We're fixing to share it with you.
Yeah. So my opinion is I would like to. I've read a lot of books and I've got a lot of techniques. I want to create a side LLC that manages all our stuff. Have enough properties in Dallas Fort Worth to have my own side company. I don't know if we'll ever manage other people's stuff, but create a company to do it because I feel like that's the plan. Train some people, train some staff to actually manage it. Follow our different stuff. Follow the stuff I've learned from Lee. Follow all the different tricks I've learned and try to do that. What do you guys think about
Lee, you want to go first?
Go ahead.
property managers?
I just manage.
Well, so Lee manages his own stuff, but I take a little bit different approach. I feel like as you start to scale and you hire a third-party management company that does that professionally for a living, I mean, that's what they do. It takes some of the burden off of you of answering phone calls, communicating, maybe trucking it back and forth to the property and whatnot. But it also frees you up to continually build your business. So you're looking for new deals, you're networking with other individuals, help to raise money, and then you can scale a lot faster. That's just my opinion. But I do own some properties, and so it's kind of my educated opinion per se. Now, I've never managed any of my own stuff. I just manage my managers. So I just kind of oversee what they're doing, and then, hey, let's probably not do that again. When they make a mistake, I mean, you end up paying for it. But as you kind of educate them, and they kind of know your feedback on what you're looking to do, then they can manage that property a little more efficiently the way you want it done.
Yeah, that's
my view.
Are you talking multifamily or single family?
Single family.
Yeah,
Like what he's doing right now.
I've always managed my own, but it's not scalable. But I never have found, and I've met some really good property managers, but never met one that's as motivated for me to make money as I am. So,
Right, exactly.
But it's not scalable, and they charge 10% of the gross. So on a $2,000 house,
Right.
They should have $1,800 a month, but it's not that. It's the vacancies. It's how long it takes them to get released. The first thing that ticked me off about property managers is when the house will go vacant, they make more money the more often it goes vacant. Because they get paid half a more month's rent.
And that's
So
something
if a tenant's moving out every 12 months, better for them, they get half of 1 month's rent every time the tenant moves out. or what if a tenant screws me and leaves or whatever. So those are things we learned early on and and I didn't have a lot of money to spare at the time, so we manage everything ourselves. It's just not scalable. I mean, I've never owned more than six residentials and not owned a little apartment complex. So I do agree with you.
So I think there's pros and cons, right?
Yeah.
Yep.
And it's kind of like, I guess, depends on your business model, what you plan on doing.
You budget that in, yeah, you budget that in.
Yeah.
You budget in the fact that they're not gonna rent it out as fast as you would, or for as much, or find the best quality tenant like you would. I mean, you literally budget that in and you scale, and you just churn and go as fast as you can.
Right.
Go from 6 to 12 to 18 properties.
Yeah, I think a lot of really good points. The fact that, yeah, I don't want to continue. I want to find deals. I want to spend my time doing that. And but you gotta account for that when you're looking at your cash flow. You gotta, even if you don't, we try to account. Even if we're self-managing, when we're evaluating the deal, we want to make sure we can still cash flow even with a property management company. They're pretty close. They're closer to break even with a property management company at this point, which is why we are self-managing. But that was what the other thing I didn't bring up in the presentation is appreciation. I didn't really touch on. So you're getting it in Midland for sure now. Maybe a little bit unpredictable though. In Dallas-Fort Worth, they've had appreciation like 6 to 10% year on the last several years, each year, and it looks like it's going to continue. So the cool part is those 6 properties I mentioned. We control 1.15 million worth of property. That's right there. It's the power of leverage, right? So we didn't put up $1 million, but we get appreciation on $1 million. If we make 6%, that adds up really quickly. So sometimes I'll look at maybe breaking even cash flow is worth it in that scenario in the right market. But I mean, me personally, I invest for cash flow. That's what I've always done. Appreciation is a bonus, but definitely a cool thing about Dallas-Fort Worth. It's growing. I mean, there's still demand for rentals. I don't see anything changing. What other questions? Yeah.
Are you, for your properties in DFW, did you do that through a realtor, or did you have a lawyer draw up the papers?
Oh, okay. Drawing them up. Yeah, so that's a simple thing. I thought you were going to ask how we source them, but that's how we source them. But so it's really easy. So you just go to the website, the Texas website. So to me, I used to think you need an agent to buy stuff, but forget that. I think you need an agent on the back end because I don't want to show my house. I don't want to get it all ready, deal with that. But buying a property is so easy. All it is literally you could print off the contract it's on the website. It's called the Trek website. Go print off the contract. Just go to the house and get it signed. Like I probably wouldn't do that on your first one, but have somebody walk you through it the first time. But the contract's easy. You go and then you still go through a title company, check your title and everything. But to me, a real estate agent, especially if you're an investor on the front end, there's not much value. Like you're looking at the deal. They're good to bring you deals, and so we do get some through the MLS, and we tell agents, hey, you keep both sides of the commission to try to bring us deals, so they get 6%. But I've had some agents where they bring me a deal on the MLS, and it's like, I want to pay you for finding me this, but I don't want to pay you to go help me close a loan because I know how to do that. It's not very hard. Does that kind of answer it? Is that what you're getting at? I mean, you could have a lawyer. So multifamily, definitely get a lawyer. I know. We looked at a 10-plex, and I know Mike's seen that one. We got a lawyer on that because there's a lot more to that. But these single families, the contracts are straightforward. And we're not that's the other thing too, we're cash offers. We don't do a whole lot of inspections like that one house you guys saw. I mean, it was gutted. Like, what else could be wrong? We're not scared of a whole lot. Depending on the house, I mean. And that's why we send out a contractor first before we make a bid. And he's pretty good. He can look at the roof or the foundation or plumbing and have a pretty good idea. What else? That's the other big thing I didn't talk about much is GC. Find a good GC. Our guy's turnkey. That allows us to find deals like Mike was talking. Let him do the projects. He's turnkey. He does it all. Like I said, we buy it, turn him loose. He gives us some pictures. We go check on it a couple times. But at the end, he gives us a product and we're ready to refinance. Go ahead.
For your hard money lenders, do they finance here? Would they win houses here?
Awesome question. And I forgot to mention that. And that's why I wanted to talk. I didn't want to just tell you guys all about Dallas-Fort Worth to get you all excited, but the one guy that did this deal here, and yeah, you'll have to, you guys definitely go home and watch that. Oops, yeah, go home and watch that YouTube video. This guy has told me, so perfect example of that property we just looked at. What was it on Dengar? That one, he told me he was going to lend off ARV of 300,000. So he'll do 70% of 300,000. So on that property, he was going to loan 210. So that's how I came up with my offer. I was at 140 plus 100, maybe 120, and then it was going to be more than 210 when he would loan, but I was going to come up with a difference. So anyway, he has said he will lend in DFW. So this guy he will lend here in Midland. He'll lend anywhere in Texas, even if you're any market. Downside of that guy though is you are going to have to send them invoices. It's going to cost a couple $100 to get your draws. But if all else, use them to get the property under contract for the purchase price. I mean, it really depends on your rehab, like that one. If it's $80,000 to buy, $80,000 to fix up, then it's worth taking some draws. But he'll lend out here. I'm starting to work on some more, but that really good one, that private guys, they're just Dallas. They're the first ones I asked, obviously. Will you guys lend in Midland? But they didn't want to touch Midland. But honestly, I think more people are gonna. That guy that I just talked about on this deal, he's like, absolutely, I'll lend in Midland. He's like, that's a strong market. Everybody knows it. What houses are going for here.
Have you checked into? There's a couple really, or more, maybe 3 or 4 really good websites that are pretty easy to lend, to borrow from. Lending Home, that y'all probably heard of Lending Home. They'll loan up to 75% of ARV. For flips, they also do fix and flip loans, and they do rental loans, which is like what you're talking about. And then there's a really good one called Lending One, lendingone.com. And they're like, I think they'll do up to like 80% of the ARV.
Really? And
and you wouldn't have to. I mean, look, they charge points. Yes, they charge points. Yes, they charge interest rates. I think they're more around like 8.5%, 9% interest rates, and you got to go through some of the same issues. But